Welcome to episode 57 of the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamilton. Today, we're diving into some intriguing developments in the real estate market that could have significant implications for buyers, sellers, and industry professionals alike. In this first segment, we're focusing on the recent drop in existing home and condo sales as buyers wait for more rate cuts. The Bank of Canada's recent rate cut was expected to boost the housing market, but the country's largest real estate board says existing home and condominium sales activity remains mostly on hold as buyers wait for more reductions. The Greater Toronto Area saw 6,113 home sales in its systems in June, which is a 16.4% drop compared to the 7,429 sales reported in June 2023, according to the Toronto Regional Real Estate Board, or TARREB. Interestingly, new listings rose to 17,964, marking a year-over-year increase of 12.3%. The average selling price was $1,162,160, down by 1.6% from a year ago. TREB has indicated that the central bank must repeat its June decision to cut its overnight lending rate. In fact, the board suggests that several reductions will probably be needed before sales volume rebounds. Jennifer Pierce, president of TRREB, stated, "The Bank of Canada's rate cut last month provided some initial relief for homeowners and home buyers. However, the June sales result suggests that most home buyers will require multiple rate cuts before they move off the sidelines." Once home sales in Greater Toronto gain momentum, an ample number of homes on the market should ensure pricing does not jump. Jason Mercer, chief market analyst with the board, commented, "The GTA housing market is currently well supplied. Recent home buyers have benefited from substantial choice and therefore negotiating power on price. Moving forward, as sales pick up alongside lower borrowing costs, elevated inventory levels will help mitigate against a quick run-up in selling prices." Now let us take a look at Calgary, which also saw a significant drop in home sales in June. Sales tumbled by 12.8% from the same month in 2023, while new listings decreased by 3.6% and inventory rose by 9.2%, according to new numbers from the Calgary Real Estate Board. Condo sales in Calgary were down by 8% for June, as properties priced under $300,000 were scarce. The board blamed a shortage of affordable homes across all residential property types. Anne-Marie Lurie, the organization's chief economist, said in a statement, "The pullback in sales reflects supply challenges in the lower price ranges, ultimately limiting sales activity. Despite the decline, 40% of the homes sold went for over the asking price, and the unadjusted benchmark home price rose 9% over last June to $608,000, according to the board. The biggest increases were seen in the northeast and east sections of Calgary. These numbers come amidst a population surge in Alberta's biggest city. Calgary's 5.9% population growth between 2022 and 2023 was the highest of any of Canada's 6 metropolitan areas, with a population of over 1 million, according to recent Statistics Canada data. However, its 8.1% unemployment rate remains one of Canada's highest, although it is partly explained by the 73% labor participation rate, which is Canada's highest. Switching gears to Vancouver, Canada's most expensive city for housing, the Greater Vancouver Realtors said the area has become a buyer's market, with inventory continuing to accumulate to levels not seen since the spring of 2019. June sales in the region were 2,418, a 19.1% decrease from the 2,988 sales recorded a year earlier. The sales numbers were 23.6% below the 10-year seasonal average. Andrew Liss, Director of Economics and Data Analytics for the Greater Vancouver Realtors, noted, "The June data continued a trend we've been watching where buyers appear hesitant to transact in volumes we consider typical for this time of year, while sellers remain keen to bring their properties to market. This dynamic is bringing inventory levels up to a healthy range not seen since before the pandemic. This trend is providing buyers more selection to choose from and driving all market segments toward balanced conditions." Like Toronto Realtors, Vancouver agents are hopeful the Bank of Canada cuts its interest rate again. The central bank is set to release its next announcement on July 24th. Andrew Liss added, "This is yet another factor tilting the market in favor of buyers, even if the boost to affordability is modest. But June's lower-than-normal transaction volumes suggest many buyers remain hesitant, which has allowed inventory to accumulate and has kept a lid on upward price pressure across market segments. The group's composite benchmark price for all residential properties in Metro Vancouver is currently $1,207,100, a 0.5% increase from a year ago, and a 0.4% decrease compared to May 2024. Meanwhile, Montreal proved to be a bright spot in June. The greater metropolitan area saw a 6.4% increase in residential sales over the same month last year, according to the Quebec Professional Association of Real Estate Brokers. Lastly, the Royal Bank of Canada issued a report suggesting that housing has a long way to go to reach affordability, but is headed in the right direction. The report states, "We think ownership costs have room to fall further in the period ahead." In June, the Bank of Canada initiated what we expect will amount to a full 2 percentage point cut in its policy rate to 3% by the end of 2025, which will bring down long-term rates as well, but to a lesser extent. The report highlights that rate cuts will drive this movement toward affordability. Now let's shift our focus to a major development in Ontario's real estate market. The combined value of all real estate in Ontario is now estimated at a staggering $3.14 trillion. This new valuation comes from the Municipal Property Assessment Corporation, or MPAC, and marks a significant increase from the previous year's tally of $42 billion. One of the key drivers behind this massive valuation is new construction projects across the province. For instance, developments like the one at 407 Dundas Street West in Oakville have contributed to this increase. The continuous growth in new builds and developments is pushing the overall value of Ontario's real estate market to new heights. Toronto, in particular, has seen a notable rise in property values. According to the MPAC report, the value of properties in Toronto alone has climbed to $9.93 billion. This increase highlights the ongoing demand and the premium that buyers are willing to pay to live in Canada's largest city. The MPAC report also sheds light on the broader implications of this valuation. Higher property values mean increased property taxes, which can impact homeowners and renters alike. While this can be a boon for municipal budgets, it also raises questions about affordability and accessibility in the housing market. With such a high combined value, Ontario's real estate market remains one of the most lucrative and dynamic in the country. The $3.14 trillion valuation underscores the importance of real estate in the province's economy and its role as a cornerstone of wealth for many Ontarians. As we look ahead, it will be interesting to see how these valuations influence future developments and policy decisions. Will we see more initiatives aimed at increasing affordable housing? Will there be new regulations to manage this immense market value? Only time will tell, but one thing is certain. Ontario's real estate market is a critical component of its economic landscape.